Welcome to the Explainer. Today, we're completely flipping the script on how you look at the markets. We aren't here to talk about picking the next hot stock, right? No magic chart patterns today. Instead, our goal is to fundamentally shift your mindset toward managing your own psychology to completely eliminate self-sabotage. Look, if you can master the person looking back at you in the mirror, the markets, they actually start to make a whole lot more sense. So let me ask you a question. What if you were 100% responsible for your trading losses? I know, it's a bit of a provocative question, isn't it? We all naturally want to blame the Fed, or some sudden news event, or market makers for our red days. But establishing this paradigm shift is absolutely mandatory. Your own emotions, your biases, your psychological baggage, they are the actual villains in your trading journey. Until we accept total responsibility, we literally can't fix the leaks in our portfolio. Okay, let's dive into this by fundamentally redefining a word we use all the time: mistake. Legendary trading coach Van Tharp has a very specific definition. A trading mistake is strictly defined as failing to follow your written rules. Notice what is not in that definition. A mistake is not simply buying a stock that goes down. If your tested system told you to buy, you bought, and it hit your predetermined stop loss, hey, that's not a mistake. That's just the cost of doing business. A mistake is when you violate your own system. Which brings us to part one, the massive cost of errors. To really understand the math here, we use a concept called R. And R simply stands for your initial risk. For example, if you buy a stock and plan to cut your loss if it drops by $10, your 1R is $10. Simple enough, right? But here is the absolutely crucial point. Research suggests that for a leverage trader, a single emotional slip-up, a mistake where you break your rules, costs an average of 4 times that initial risk. Seriously, a 4R penalty. Just one moment of panic, or one time you move your stop loss because you know it's going to bounce back. Boom, you've just suffered a massive 4R penalty. Self-sabotage is literally like feeding stacks of cash into a bottomless money pit. Think about the financial drain here. If one mistake costs 4R, what happens if you make just 10 mistakes in an entire year? That drains 40R right out of your portfolio. To put that into perspective, just 10 moments of poor discipline could turn a year that was supposed to be 100% profitable into a mediocre 50% year. Or worse, it could push a break-even year deep into the red. It's wild. Moving on to part two, vitamins for the soul. This is your psychological toolkit. Unaddressed emotions, things like fear, loneliness, or rejection, they act like a stored electrical charge in your body. And if you don't actively release this stored charge, it is going to leak into your trading for sure. You might exit a perfectly good trade early, simply because your brain is trying to avoid some stored feeling of rejection, not because the chart actually told you to sell. So how do we fix this? Well, one incredibly simple way to release those minor charges is through what's called the God box exercise. Whenever you feel daily irritations or worries bubbling up, maybe a really frustrating commute or an argument with a friend, you just write it down on a piece of paper. Then you place it into a physical box on your desk and consciously choose to forget about it. It acts as a physical clearing mechanism. It ensures that when you sit down at your trading desk, you have a completely empty and focused mind. Now, for much heavier emotions, like deep grief or intense fear, we use the park bench technique. Instead of fighting the feeling, which is what we usually do, right? You sit in a neutral spot, like a park bench, and you commit to intensely feeling that negative emotion for 1 full hour. No distractions, just feel it. And what happens is completely counterintuitive. The feeling actually gets incredibly boring. That active commitment makes the feeling fade. Then you just reduce the time daily, down to 45 minutes, then 30, then 10, until that emotional charge completely dissipates and no longer controls your actions. All right, part 3, the daily mental rehearsal. This is your pre-game ritual. You absolutely must ask yourself this question every single morning. What could go wrong today that might cause me to make a mistake? Consider this story of a highly successful European day trader. One day, he gets a call that his girlfriend had been in a severe car accident. Naturally, he rushed straight to the hospital, but he left his trading positions open without physical stops in the market because he normally just used mental stops. He didn't plan for a personal disaster to suddenly pull him away from his screens. This proves exactly why you must plan for absolute worst-case scenarios. To protect yourself, you need to walk through these 3 steps daily. First, ask what could go wrong. Second, get creative. Imagine power outages, a sudden market crash, or, like the story, a family emergency. Third, mentally rehearse your proper procedural response to those exact disasters. If the power goes out, your rehearsed response might be calling your broker immediately to flatten all positions. And once you've secured your downside, then take a moment to mentally rehearse a perfect, highly disciplined trading day. By practicing both crisis and success in your mind, you ensure you always respond with rehearsed discipline instead of pure panic. It can literally save your financial life.
Which leads us to part 4, evolving into a business. This is the ultimate shift to becoming a super trader.
Let's contrast two very distinct mindsets. You have the average investor who basically treats trading like a hobby. They trade on hot tips, gut feelings, and emotions. They're just looking for the thrill. But a business owner trader operates entirely differently. They treat trading exactly like running a franchise. It relies on tracked metrics, computerization, and rigid, heavily tested procedures. There is absolutely no room for emotional guessing when you're running a successful business.
In peak performance requires strict adherence to daily procedures. Taking a walk, meditating, and keeping a daily emotional journal to prevent repeating those same psychological errors, these aren't just nice ideas or self-help fluff. They are the mandatory operating procedures of your trading franchise. Having a checklist keeps you grounded in the actual process rather than obsessing over the day's profits and losses.
A huge part of that routine is tracking your data. A business owner trader doesn't just check if their account went up or down. They track specific metrics to monitor their systems. We're talking things like R multiples for every single trade, the overall expectation of their system, the standard deviation of their R multiples, their daily P&L, and their annualized Sharpe ratio. By obsessively tracking these statistics, you catch minor errors in your system way before they can mutate into account-destroying self-sabotage. So, we arrive at our final question for today. What are your mistakes costing you? Remember, a mistake isn't a losing trade. It is a failure to follow your rules. If every single one of those failures cost you 4 times your initial risk, how much wealth is leaking out of your life just because you haven't mastered your emotional charge? Mastering your own psychology and treating your trading like a disciplined, rigid business is the only true path to consistent profits. Take the time to clear your mind, write down your rules, and never break them. Thank you so much for joining me on this explainer, and I'll catch you next time.